The South African Government Bond Index satisfies all three of the World Government Bond Index's requirements: size, credit quality and lack of barriers to entry. So this makes South Africa eligible for inclusion in the WGBI, or the WGBI it apparently is called. We take a look at what this means for the country with Leon Myburgh, who's Sub-Saharan Strategist at Citigroup. Hi Leon.
Hi.
The WGBI. Whenever we've got an acronym, we have to find a way of abbreviating it into a word, the initials into an acronym rather, WGBI. So, sounds very technical. World Government Bond Index sounds rather heavy and bureaucratic. First of all, how did we qualify? We mentioned the criteria there. Size the first.
Yes, correct. There's a minimum size criterion. It's actually multi-currency, but to keep it simple, we've got to have $50 billion worth of outstanding debt for bonds that are eligible. And the bonds are chosen based on having at least 10 billion rands worth of outstanding amount. So when you look at the current bonds, the government bonds, of course it's a government bond index, so it's just governments. All of the major 11 government bonds have sizes in excess of 10 billion, so we'll have 11 government bonds included in the index.
Okay, the second one is credit quality.
Correct. Minimum credit quality to come in is local currency rating of A negative. South Africa meets that requirement, so therefore we get in. Yeah.
And lack of barriers to entry, in other words, to buy the bonds.
Correct. I mean, and that has always been one of the big pluses of South African bond market. Even during the time of exchange controls, foreigners were able to freely trade and hedge any listed instrument, including government bonds.
So is this a thing that's happened all of a sudden, or have we met some of these criteria some of the time?
No. I think we've potentially been eligible for some time. I can't speak to exactly why the decision came in now, but because this is run by the research unit of Citibank. But South Africa meets the criteria, and there are other emerging market countries. Mexico's in, Malaysia's in, Poland is in, as an example. But it is heavily dominated by the G7 type debt. So Japan forms nearly 30% of the index. The US is in there, the UK, and that is probably one of the important points about the index is that this is not an emerging market index.
These are the big boys.
This is a global index where non-EM dedicated funds will be putting money into South Africa. So what it does is if we successfully meet these criteria for the next 3 months, we will get a whole raft of new investors coming into
Well,
South
let's
Africa.
look at that. And I suppose what we want to know is there are technical issues here, but how important is this to the country?
It's actually very important. We don't know the exact quantum of funds that are managed against the WGBI. I mean, but we do know it is sizable, and we estimate it to be probably in the vicinity of $2 trillion. Now, at 0.44%, which is the South African rate, which sounds tiny, and it is small, but you relay that back into dollar terms and you end off with a number something like $9 billion. Right? So this is potentially significant. It could have huge inflows coming into the country.
Give me an example of a company, a treasury, investors, who will now do things differently as a result of this.
Well, this is, from my understanding, the WGBI is very popular in Asia to use as benchmark, and they passively track the benchmark. So whatever goes in, goes out, that they'll replicate that in their portfolios. But then there are many funds around the world who also track it, but they might have more active investment horizons. Now, these funds will sit down and as I say, there's $2 trillion worth of assets, tracking this index, and they'll sit down and they might not have looked at South Africa previously because it wasn't part of their mandate. And suddenly, at the end of June, if South Africa continues to meet the requirements, at the end of June they'll be told at the end of September, or basically from early October, South Africa will be in the index, and therefore if they want to match the index, they will have to buy South African bonds, government bonds, as a process.
Does this, in the same way that other indicators we've talked about today, the banking confidence index, for example, which I know is a different thing, but these indexes can have an effect which then reinforces what they're saying. So you're confident, that reinforces confidence, therefore it gets more confidence. Is this the kind of statement or knowledge that people will say, this is important and I now feel better about the economy, I feel better about future growth?
Well, it's certainly a big statement of confidence in the country that the country has met this minimum,
in a sovereign sense.
In the sovereign, yes. It's a very positive affirmation of the sovereign in South Africa. That South Africa is good enough to be included within the world platform of non-emerging market dedicated assets. There are many countries who are in indices, and they're all, even Citibank has its own local market, emerging market debt indices. But this suddenly takes it transcends that and goes to a higher level and brings in a whole bunch of new investors into the fold that previously would not have thought about buying South African debt.
Now, I know that entities like Transnet and Eskom are corporatized. They sell their own bonds, and it's a very important way of raising money for them. Is there any spillover from this into the Transnets and Escoms?
Well, technically no, not directly, but what it could do on an indirect basis is that South Africa will become better marketed with the global investor base. And increasingly you might find that maybe government assets outperform relative to the Escoms and the Transnet bonds, and as a consequence the yield becomes relatively more attractive in the parastatal debt, and therefore that might have previous investors in the government market who weren't necessarily WGBI trackers, they were just simply fund managers, might suddenly find, but why am I going to buy the government bond if I can actually get 20, 30, 40 basis points extra on parastatal debt, which is also government guaranteed. So you might find indirect spillovers, but not on a direct basis.